Trading is a rigged game and the odds are completely against you. Every day, millions of people rush into the stock and the FX market, hoping for quick profits and financial freedom. But what if I told you that for the most it's a losing battle from the start? Today, I want to deep dive into why online trading is designed for you to fail and what are the real winners doing instead. How do I know? Because previously than joining tech, I had the privilege of experiencing the financial market from the inside, working at a small proprietary trading firm where we traded exclusively with the firm's own capital. We were executing more than 2,000 trades with a combined volume over $30 million every single month. And in this experience, I saw firsthand the complexities of real trading and the stark difference between theoretical strategies that work on backtesting and the real execution in the live markets. And beyond just executing trades, I had the possibility to connect and speak with thousands of key players in the trading industry. From speaking with brokers, liquidity providers, and some of the most experienced traders in the most prestigious trading firms in the world. These conversations expose me to the realities of trading, and today, guys, I want to show you the behind the scenes of this industry, who's really profiting from trading, and which are the real firms that actually are able to beat the market year over year, printing billions of dollars every single year in trading. And let's get to it. First of all, guys, I would like to enlighten you on what's happening in the retail brokerage industry, where your favorite gurus make YouTube, Instagram content showing how they make $10,000 per day with FX or stock trading, which is something that is not possible actually with trading in a retail way. And those gurus sell you the dream. So their job is to sell you the dream of turning $10,000 into $1 million by trading. They show you the high life, the luxury, the cars, and they pretend to have some kind of strategy, some kind of technical analysis that can actually beat the market and make consistent profit. But here's the truth, that's all fake, guys. And I'm going to share with you in a second how those gurus really make their money. First of all, what those gurus don't tell you is that the reality is that from 70 to 90% of retail traders lose money. And there are multiple studies that show you this. And also, if you notice, those CFD brokers in their banner must show you how much of their clients are actually losing money, right? But nobody cares about that, right? So that is a fact, guys. For example, a study conducted by the North American Securities Administration Association has shown that approximately 70% of retail investors lose money. And again, another study from the University of California, Berkeley, this is crazy, guys, showed that only 10% of day traders are profitable after 1 year of trader, and this percentage goes down to just 1% after 3 years of consistent trading. So guys, you can not make money with day trading, okay? Yeah, please, I will give you a bunch of reasons why the industry is designed for you to fail. But yeah, one step at a time. So first of all, let's see how those gurus really make the money, because they become rich actually, but not by trading. So how they make most of their money is in two ways. So first of all, some of those sell you courses with some kind of strategy and how to find the best strategy in the market, but that's all crap, guys. Especially technical analysis is something designed for the retails, and we will see later that the best players in the trading industry, the firms printing billions of dollars in profit every single year, are not relying at all on technical analysis. So technical analysis is something just for retails to find a rationale behind just flipping a coin and going long short. You want to find a rationale, seeing some kind of triangles, support and resistance areas, and because the human nature want to find a rationale up behind, winning and losing trades. So those gurus, some of those sell you courses on how to find the best strategies and how they found theirs. How they make majority of their money is actually another way. And you think that is a marginal part of it, but it's actually the biggest chunk. And it is referring you to retail trading brokers. So if you notice, every time those gurus want you to trade leveraged positions, and for the most, those are CFDs, brokers. With this model, the introducing broker agreement, what they get is, first of all, the so-called CPA, that's called cost per acquisition. So each time you open an account with a certain broker, you deposit money, they get a fat commission as cost per acquisition, right? And that could be fine. But there's not just it, guys, because they make a lot of money actually also from splitting the trading fees that you pay to the brokerage you have signed up. And each time you trade, the spread and the trading commissions are split between the broker and the trader, right? So they make a lot of money. So they essentially what they do is they show you how to trade. They think they have an edge, but they actually don't. They just want you to produce trading volume, because the more trading volume you do with their brokerage, the more commissions you're gonna pay to the broker and to them. So it's a quite substantial amount of money, guys. Sometimes people don't realize, but if you combine the spread and the trading commissions, multiplied for millions of dollars in trading volume, because they have big audience, and you sum the CPA, you actually become rich, guys. But they didn't become rich with trading itself. And it's kind of shady, because most of those commissions are actually paid out introducing brokers when the customers, so the retail customers that join the broker, lose money on the platform. And we will in a second how is the market structured. But again, you may be thinking, well, the guru I know shows consistent winning trades and profits on YouTube. And sorry guys, this is funny to me, because the truth is that they only show you a selected batch of trades. So you have just to remember that what you see on YouTube sometimes, Instagram, social media, is not the reality. If they show you some winning trades, it will probably be that they have so many losing trades that they will just don't show you. So imagine you are flipping a coin, right? You have 50% chances of head and 50% chances of tail. And that's exactly how those strategies of gurus are performing. Like they're just always in the market. They don't have real edge. So it's like flipping a coin. Okay, let's go long, let's go short. Then they find a rationale, because support, resistance, triangle, that kind of crap. But that's just noise in the market. So what they will show you is, let's say they do, 10 trades, they will show you just the 5 winning one and probably 1 losing, when actually they probably made, 5 winning and 5 losing. And most of the time, actually, they have more losing trades, so 7 losing trades and 3 winning trades. And they will just show you the winning ones. And you will be thinking that their strategy is working, right? And guys, the fact is that with a noise strategy like that, 50% chances of winning, 50% chances of losing, which is actually better than those strategies you see on YouTube. Eventually, they will not net zero, because you have spread and trading commissions, which in the long run are becoming bigger and bigger, and they're impacting your balance. So you will be underwater. So your profit will be below zero. So you'll be negative. And the psychological power kicks in when traders make, a few wins, and they think they found the strategy, right? When in reality, that is 99% of the case, just luck. So let's say you perform, let's say you do 10 trades in a row, in a month, okay, profitable, okay, at profit. And this is something that is very, very, very difficult, okay? So tell me a trader that does 10 trades in a row at a profit, right? Without any losses in between. So assuming that this even happens, what would kick in after this is a psychological trap of the trader thinking he has found an edge and just, over leveraging its position and then wiping out the profits in one single trade or in a couple of trades. Because actually, to build an edge, and we will see this later on how the best firms in the world are actually doing, you need to have a statistical edge over years of forward trading. I'm not talking about backtesting, but forward trading. So 1 month, 10 trades is not a big sample enough to state you have a winning strategy. And the psychological human part will tell you, oh, I have a strategy, I have an edge, let's go big on this, and you will wipe out your profits. So this is how big component of traders lose capital, just because after a couple of wins, it's not even 10 in a row. Sometimes it's just 3-4 trades. They think they have an edge, they over leverage, they wipe out the profit and the bankroll essentially. So guys, we have understood that retails are consistently losing money, papers are showing the numbers, and gurus are actually making money from you to referring the broker and not actually by trading themselves, right? They will show you just a couple of winning trades, but they will not show you the losing one, and they do not have a statistical edge over the market. Oh guys, I'm getting excited because this is something that nobody is talking about. And it's crazy to me how this industry really works, because at the end of the day, trading is designed to be a zero-sum game. So if we have losing traders on one end, there should be someone winning, right? So we have understood that the gurus make their profits by selling new courses, introducing to the brokers, and the brokers themselves make money by the trading fees, right? But who's the counterparty? Who are the players on the other side of the spectrum? The guys really profiting from the retail traders losing money. Well, those are called market makers and liquidity providers, right? So those big guys essentially act as counterparty to the retail trading flow. So if you have a losing flow, the counterparty will be a winning flow. Those guys can be the counterparty because they have big balance sheets. I will probably do an in-depth video about market maker and liquidity providers, how this thing really works. But they have to know that retail trading flow is a losing flow, and you have big guys, liquidity providers, market makers that are the counterparty to that flow and essential profit from it. And in the middle, you have, as I told you, the gurus referring you to the brokers, making you trade and do the volume, and you have the brokers who earn from spread and commissions. And some of those brokers actually are so big that can be the liquidity provider market making for themselves. So that basically means that they are trading against their own customers, right? So the retail traders are being filled their order by the brokers, right? That's in a nutshell how the industry works. But again, I wouldn't blame so much the brokers, because the problem is more the retail traders that think they can turn $10,000 to $1 million, and the brokers will eventually just give to the customer access to the market, right? Nobody is forcing you to go long Tesla or go long effect, to go long USD euro at a certain pair. It's more kind of, I would say, the gurus and their marketing that are selling you the dream that it's actually not possible. The broker will give you access to the market, and the big guys, the liquidity providers, are just smart money that are playing against dumb money, and that will be just your counterparty. So each time you place a trade, think who's gonna be on the other side of your trade, filling up your order. And if you think they're smarter than you, well, you're probably gonna use and they're probably going to win. So guys, I hope you now understand on a high level how the online trading market is structured. So on the one hand, you have the retail traders, in the middle you have the brokers, and on the other hand, you have the liquidity providers, who are the counterparty to the retail trading flow. And sometimes the broker can be the counterparty themselves to the retail flow, because if you know you have a losing flow, you want to be the counterparty to that flow, right? As easy as it sounds, it's like this, right? So that's actually why you see a lot of brokers emerging, and a lot of influencers actually, they want to start their own brokerage firm, because that is a profitable business. And if you actually can do the counterparty to the losing flow, well, you have a winning flow, right? But guys, you may be wondering, is there someone in the market who can actually find a real alpha, real edge, and be a successful trader? So actually beating the market, finding market inefficiencies, and print billions of dollars in profit by doing so, and not just being the counterparty to the retail trading flow and acting as a liquidity provider? Well, those players, guys, exist. And I'm talking about quantitative trading firms. Some of the biggest names in the industry are Jane Street Capital, Jump Trading, Citadel Securities, Two Sigma, Optiver, Hudson Trading, and many more. So these are, guys, the best trading firms in the world-class level. And those firms, guys, don't rely on bullshit technical analysis, triangle, support and resistance, and that kind of stuff. They find statistical edges, leveraging their brightest minds they have in their company, the so-called quants. Like, they have mathematical and statistical edges proven to work time over time. And yeah, so if you want to become a successful trader, you should join those companies. But let me tell you how those companies are structured. So the real traders, the real guys that can find the alpha in the market inefficiencies, and essentially build a strategy that fills that gap of market inefficiency, are the so-called quant researches or quantitative researches, right? Quantitative is a way to call those guys, because they all have PhDs in mathematics, physics, statistics, and computer science. Essentially, those companies pay a lot to those guys to find those inefficiencies in the market. And essentially, they form groups of super smart quantitative researchers, and those guys, with the use of a lot of statistics involved and proprietary algorithms, are able to find alpha in the market and not rely on backtesting guys, but actually do forward testing and see if their strategy over the year, starting with a small amount of capital and then moving up to the millions and billions of dollars, can actually beat the market. And in those firms, so you have the quantitative researchers, and then you have the traders who actually execute the strategies that the quants have found, right? But it's not just about that, because you may be thinking, oh, I hold a PhD in mathematics, I know statistics very well, and I can find a strategy on my own. Is that those guys, those quants, some of the brightest minds in the world for the financial markets, are the ones who tell you and told me that if they were, alone, or just a, group of them in their house, their building, or their office, without the infrastructure they have in those firms, they wouldn't be able to beat the market and find strategies that actually work, because those big firms have access to liquidity deals and trading conditions that are completely impossible for the retail traders. And I'm talking about extremely low spreads and trading commissions. And you may be thinking that your retail trading broker offers you low spreads and fees, but guys, the kind of fees you have in mind are not low fees and spreads. Because they have millions and billions of dollars in assets under management, they can access liquidity deals that are just impossible to a normal trader. And also they have ultra low latency connections when retail traders actually trade on delay most of the times, right? You may be thinking you're executing fast your trade, but actually it is not. Those guys, to get those market inefficiencies, those arbitrages, and that kind of alpha that is extremely difficult to find, they have some kind of connections that are just impossible to have, partner in your office or whatsoever. Now, guys, I want to enlighten you on the myth around backtesting, right? Because a lot of the trading experts you find online show you backtesting, how to do backtesting, and all that kind of crap. But the thing about backtesting, and the big fallacy about that, is that backtesting cannot count price impact. So what do I mean by that? Is that when you look at a strategy in the past and you say, oh, if I had gone long here and short there, I would have made profits, is that the fact that if you actually had done that in the past, so you go back in the past, you actually placed a trade, the market would have reacted to your positions and the history would have been different. So the chart essentially after that would have been different, and probably you thought that going long would bring you profits. The market may be reacting in a different way, and you may have lost your money and lost your edge. So the big problem about backtesting is that it doesn't count market impact of your trades. Of course, if you were just to place trades about, a couple $100, couple $1,000, probably the market would not react very much to your position. But with those sizes, you cannot make a living with trading, right? So if you actually want to consistent profits and make a substantial income with trading, well, the market would have reacted to your back-tested strategy and history would have been different, and probably you would have lost money if you just rely on that. So that's why those big firms rely on deep statistical analysis of the strategies they find, and not just back-testing tools and that kind of stuff. And also they focus a lot on forward testing. So before making a strategy live, they test the strategy forward, so in the real live markets, to confirm they actually have the edge, and they don't rely on the back testing, but they actually want to see if there's this market inefficiency is something that is actually happening in the real markets, and if they place a trade, how the market would react to their trades. Because most of the times these firms, and this is something also that's very interesting, and in a second I will tell you why copy trading is one of the biggest scams out there, is essentially because those players, the trading firms printing billions of dollars of profit, they are super assertive of their strategies. And so when they execute in the market, they try to make it impossible for someone to understand what is their strategy. So they use multiple liquidity providers, multiple trading values, just to make it impossible for someone to go back and see what is their strategy. Because the thing about trading strategies that actually work, so those kind of alpha, is that that kind of edge and alpha has a capacity. There is not a strategy with a limited capacity. When I talk about capacity, what I mean is that essentially beyond a certain trading size, the edge will just disappear because the market would have reacted so strong to your trade that, if you go long and essentially want to buy at a low price and sell at a higher price, and if you place a trade that is too big, so you go above your capacity, the edge will not just be there, right? So those firms essentially want to make sure that nobody discovers their strategy, because otherwise someone will fill the capacity of the strategy for them. And this is why copy trading is just one of the biggest scams out there, because if a strategy actually works and you have an edge, you don't want other people to copy you, because otherwise that will fill the capacity for you and you will not have the edge yourself. So this is in a nutshell, guys, why copy trading, it's not working. And the real business behind copy trading is just for you to copy a certain trader who earns not from your profits as they claim, but just from the fees they pay to the trading brokers that are split with them, the spreads and the trading commissions. And you just want to, make noise and increase the trading volume just to get more commissions. And that's how those copy traders, or the guys who sell you the software for trading or that kind of crap, or they claim, oh, just follow me for free and you will print profits, you can just copy my trades. This cannot work, guys, because I'm telling you, the biggest firms in the world are super secretive of their strategies and they don't want anyone to find about it, right? It's just like that, because the thing is that each strategy has a capacity, and if you have a real edge and those gurus clearly don't have an edge, you want to maximize the capacity for yourself, right? So for your company, so you want to make the trading volume for that kind of strategy just for yourself. That's how it really works. And copy trading is just increasing volume, making more money to the broker, making more money to the introducing brokers. So guys, what should you do? I hope you now understand that online retail trading is a rigged game and why you cannot make money and who's profiting from you. But what should you do instead if you have a passion for trading? So if you really have a passion for trading, for statistics, mathematics, and so on, what I recommend to you guys is to try and apply and go work for those trading firms that I mentioned before, world class in trading. And there you will really learn how to find an edge in the market, execute trading strategies to make the market efficient essentially, and really become a professional trader. You will earn millions of dollars in your career there. And that's something I think extremely interesting. And if you want, guys, for me to interview some of those quants, please let me know and I will try to schedule an interview for you guys. And for the others who don't have this kind of passion, for statistics, mathematics, and so on, like myself. So I have a strong passion for the financial markets, but my passion is more on understanding how the economy works, how the financial markets on a macro level work. And one of my biggest passion is sales, and that's why I'm working now in tech sales. For us guys, the best way is to play not a zero-sum game, so not the trading game, but the investing game, which is a positive sum game. And I'm talking about, that's what I always recommend, invest month by month, year by year in diversified stock indexes like MSCI World, S&P 500, the Nasdaq, and so on, because that's the way on how you can really build wealth without the stress of constantly looking at charts and prices, but you are actually investing and going into a positive sum game. And why do I say investing is a positive sum game? Because essentially, let's say you're investing in the MSCI World, so you own equity in the biggest companies in the world. So you are diversified across countries, across industries, and essentially you are betting on the global GDP to continue to rise in the future. And history has proven over more than 100 years of the stock market that this is the case, right? Because of technology will continue to progress, and essentially humans will continue to progress. And if you own equity with a diversified stock portfolio all over the world, with companies all over the world, essentially you will benefit from the positive growth of those companies and of the overall GDP of the countries, because businesses and countries eventually will continue to expand, some faster, some slower. In the medium to long run, that's how You can make good money from investing, and this is a positive sum game where everybody can win, right? From the funds, from the hedge funds, and to the retail investors. And remember, guys, that timing the market beats timing the market. So timing the market is almost impossible. That means like doing day trading or that kind of stuff. But time in the market, which means staying invested over the medium to long run, will benefit your portfolio, and you will become wealthy by doing so over years and decades. And yeah, guys, so that's the game I'm playing and the game I recommend you to play. And as said, if you have the passion for real trading, statistics, and mathematics, and you want to really find the edges, please try to apply to one of those world-class firms in the world and make your career in trading. So guys, I hope you enjoyed this video. Please let me know what you think in the comments down below. Also on what kind of content you would like to see in the future, if more on the trading side, entrepreneurship or sales side. And guys, see you into the next video.